David, I want to kick off this interview saying the IMF was pretty much founded to promote free trade globally. We're seeing the opposite. We're seeing a lot of tensions between China and the U.S. How concerned are you?
It's unfortunate that trade tensions are arising just at this moment where global recovery is being supported by trade. For the first time in a long time, trade's growing faster than global GDP, and in that way it's spreading recovery around the world. Now, the trade tensions, one has to understand, they arise because people feel as though trade is unfair and trade advantage is being gained by other countries, and that's causing them dislocation. So we have to understand that the dissatisfaction that's leading to these trade actions has a reason. But at the same time, we think that the differences of view should be settled through cooperation and through dialogue, and that's the way to make sure that trade continues to grow, that market access increases, but on a fair basis, and that way everyone can still gain.
I understand. So you would think the U.S. does have a point when it comes to China. Is the way they're doing this that might not be the most appropriate?
Well, I think the U.S. is not alone in being concerned about Chinese trade practices. And I think the Chinese, if you look at recent statements by their premier, they acknowledge that some of their practices, which were not a globally significant factor when they were a smaller economy, say 15 or 20 years ago, are now something that needs to be addressed. I think the time has come for them to address it. They, too, need globalization. That's how they've had this spectacular growth, and that's how they'll have a strong future. So they need a globalization that's durable, and that means finding a way to have free and fair trade and to get along with their trading partners.
Right, and going into markets, we're seeing major reactions, especially in equities. Now, I'm just wondering, do you think we're going to get a repricing across other assets stemming from this, and what are the longer-term implications?
It's very hard to judge what's happening on a given day or a given week, but I think what we're seeing in general and what we can expect to see is that with all of the monetary accommodation and the efforts to get inflation back towards central bank targets, back towards normal inflation, this accommodation has led to rapid growth in credit, and with rapid growth in credit, one sees financial vulnerabilities, more risk-taking. So these vulnerabilities are bound to lead to some more volatility. It's a good thing for markets to become accustomed to that, to figure out how to react to that. There's no reason to expect at this point that there'll be problems. So far, the normalization of monetary policy in the United States, it's been 6 interest rate increases, has occurred without any significant negative effects, but surely people need to be alert to the fact that there are financial vulnerabilities and there's likely to be volatility.
I understand. Just really quickly to end this conversation, we've talked about China, Europe, the U.S. You're pretty happy about global growth. With these tensions that we're seeing, are you going to have to maybe revise down your forecast, or is it too early to tell?
No, I think we're seeing strong enough growth to carry the global economy through at reasonably high levels. We think 3.8, 3.9% growth for a couple of years. But it's a cyclical recovery, and the world needs to be ready that when that cycle ends, there's going to be a need to find new sources of growth, long-term sources of growth.